RBI's monetary policy has become kind of a routine affair in India every 2 months. Now, just this morning, our RBI Governor Shaktikanta made the first monetary policy announcement after the budget. Now, between the last meeting and now, there are many crucial developments that have happened. Now, first off, the US Federal Reserve has hinted at a possible rate cut by September, which can have significant impact on our markets as well. Now, secondly, the tensions between Iran and Israel have been escalating. Now, this worsening situation is crucial because it can affect global crude and commodity prices, and we all know how sensitive our markets are to oil prices. Lastly, Japan has decided to hike its interest rates, and this decision has sent shockwaves through the global markets, leading to a mega crash just this Monday. Now, coming to today's news. All eyes were on the RBI's meeting today, with everyone eagerly awaiting signs of a potential rate cut after 18 months of steady rates. Now, the central piece of news is that the repo rate, which is the rate at which the RBI lends money to commercial banks, stayed steady at 6.5%. Now, this decision marked the 9th time in a row that the interest rates have been kept unchanged. Now, why are markets craving for a rate cut, and why is it important? First, let's go back 2 years ago when Russia invaded Ukraine, which shot up commodity prices and overall inflation in many countries. Now, while moderate inflation is good and can signify economic growth, high inflation can harm both our purchasing power and the economy. So, central banks across the world usually have a target for inflation. In India, the RBI targets an inflation rate of 4% with a tolerance band of 2% plus or minus, meaning it can vary between 2% to 6%. Now, in the United States, the Federal Reserve targets an inflation rate of around 2%. However, our inflation shot up to 7.44% owing to the Russia-Ukraine crisis. And in the US, it rose to a 40-year high. In response to high inflation, central banks like the RBI, the US Federal Reserve, often raise interest rates. Now, when interest rates rises, the cost of borrowing money increases for businesses. This means that companies have to pay more in interest on their loans, which can reduce their profitability. Now, this can also deter businesses from investing in new projects or expanding, which can slow down economic growth. Now, in response to high inflation that we saw, the RBI has swiftly acted by hiking interest rates. However, the RBI has paused hiking interest rates in response to inflation falling, and the market now is eagerly anticipating a rate cut. Now, lowering interest rates reduces the cost of borrowing for businesses and consumers. This encourages companies to invest in new projects, expand operations, hire more workers, which can boost economic growth. Now, for consumers like us, cheaper loans can boost spending on big-ticket items like homes, cars, which can further drive economic activity. And all of this will have a positive impact on the stock market as well. Now, let's talk about why we haven't seen a rate cut yet. Now, while there are pockets of weaknesses, India's economy has still managed to achieve about 8% growth, the fastest among major world economies. And with about-trend inflation, there's no rush for the RBI to start cutting down rates unless a slowdown becomes a real concern. Now, RBI Governor Shaktikanta has also warned against any premature rate cuts. Now, inflation in June jumped to 5.08%, more than 1 percentage point above the RBI's target, largely driven by high food prices. And hence, we have not seen a rate cut. In summary, controlling inflation, especially when a big chunk of it comes from the volatile food sector, is no easy task. So while there's a possibility of a rate cut down the line, the uncertainty around inflation means that RBI is likely to proceed with caution. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.